Hi, everyone. Donna here with Bookkeeping Made Simple. This is the podcast where we talk about everything to do with business, from mindset and nutrition to how to think like a business owner to accounting, payroll, and tax, because that's what I work in. That is my field. My job as an accountant is to help my clients grow their business. That is really my job. And part of that is helping them to understand how money works and how they should be running the money in their business. So today I want to talk about commingling funds. Yes, I have talked about this topic many times before, and I'm going to continue to talk about it because it is one of the things that I get asked about the most. Commingling funds. Well, what does that mean? When you go to your state and you register your business, you get your EIN, you get your business license, you get registered with the state, and you set up a separate business bank account. It's one of the very first things you should do. That should be like day one. Okay, you set up a separate business bank account and you put money in that account. That account now does not belong to you, the business owner. It belongs to the business. This is one of the things I think people really kind of struggle with. It belongs to the business. Now, you can take money out of the business, but the money in the business bank account does not actually belong to you, the business owner. You are the signer on it, but it belongs to the business, which is now a separate entity from you. Why is this important? Well, most business owners today, they start life as an LLC. Most businesses do. In fact, some subsidiaries of major businesses will be LLCs. For example, back in the 90s, I drove a Saturn, and Saturn was an LLC, a subsidiary, wholly owned subsidiary of General Motors. No matter what those idiots at AutoZone tried to tell me. Guys, men, please stop talking to women like we're stupid. I knew who built my car and where it was built. Anyway, Saturn was a wholly owned subsidiary of General Motors, and it was an LLC. Now, I don't know anything about the background of it. I never bothered to look up their incorporation documents, their articles, but I do know it was an LLC. So an LLC can be a small one or it can be enormous. What it does, and this is the same for LLCs and both forms of corporations. When you set up your business in a way that limits liability, you are not the business. And this is something a lot of, especially small business owners, they really struggle with this. You and the business are no longer the same entity. If you are a sole proprietor and you didn't bother to register your business with the state, you just hung out your shingle and said, here I am, I'm in business. Then you don't have to worry about this because you are the business. But if you have other people working for you and you form a limited liability corporation or a corporation of any kind, you are no longer the business. So the money that's in your business bank account doesn't technically belong to you. You may think it does, and it's a reasonable thing to think, but it belongs to the business. If you use business funds to pay personal expenses directly from the business account, then you are guilty of commingling funds. And what that means is, as an accountant, I need to be able to very easily, in fact, I need to know that every single transaction that I see coming in through the bank feeds, coming into QuickBooks, I need to know that those are all business expenses. It is very difficult to untangle when Walmart and Amazon are the worst offenders, not their fault, but people will go to Walmart and they will buy stuff for their business and stuff for their home, and they will put it on the business card. That is a massive no-no. What I really tell people a lot is think of it as if you didn't own the business. What if you didn't own the business? What if your boss gave you a business card for business purchases, would you still do the same thing? Where if you were the CEO of a Fortune 500 company, would you do the same thing? No, it's fraud in that case. Now, for a very small business, it typically gets overlooked. But it's still a massive no-no. What happens when you commingle funds? And that does mean, that means both paying business expenses from your personal account, which is a little bit more acceptable. And it's absolutely paying personal expenses from your business account, which is not acceptable. What happens is that now we can't tell. Money's very fungible. We can't tell how much of this is the business's money, how much of it is the business owner's money. If you're using your business as an ATM, one, you lose all the protections that you set up when you set up your LLC. What do I mean by that? Well, when you set up an LLC, you limit your liability. That's what it means. And it creates what's called a corporate veil. So it creates a barrier between you and your business, where you say, my business is separate from me. And again, so if I get sued, it can't go after business assets. If the business gets sued, I don't want them going after my personal assets. But if you're using your business to pay personal bills directly from that business bank account, you've pierced the corporate veil. And that means that the judge, if you are ever sued, and if you're in business, you're very likely to be sued. Now the judge is going to look at that and say, well, they treat it like just another personal account. So all assets are at risk. We don't want that to happen. My advice when it comes to funds is, again, keep them completely separate. If you need to pay personal bills, there's nothing keeping you from having your business and personal accounts at the same bank and just transferring money as you need. Or the more thoughtful way to do it is to set yourself up with a salary. And that means at the end of the week or whenever you run payroll, you decide, well, I need I would pay someone $1,000 a week to do what I do. That does mean you have to work really hard on your pricing, but I would say I would pay someone $1,000 a week or whatever it is. When I do my own salary, I look at what I pay my staff and I pay myself the same. Now, and I just transfer that money from my business account to my personal account. And in QuickBooks, you can do it as a direct deposit. So there's no excuse. You can have the funds the same day. Now, if something comes up, you can also take money out when you don't have it scheduled. You do want to have it scheduled because it's going to help you with your budgets, both for your business and for yourself. But you can also take money out unscheduled. What that means is you can go, oh my gosh, I forgot, it's the 5th, the rent is due. I'm going to transfer this money right now to cover my rent or my mortgage payment. That's perfectly okay. But the trick you have to do is you have to recognize that the business is not you and you are not the business. And so the money has to stay in the right bucket. Your business bucket is just for business expenses. If you need to take money out of that bucket, you put it in your personal bucket and you can spend it from there. If you will do that, it will save you so much. It seems like it's just an extra step, but it will save you a ton of headaches. And I really, really strongly recommend that, yes, once you have your business set up and you have your business bank account and you have a little bit of money in that business bank account, don't spend the business money for personal reasons. Make sure the business money, again, think as if you were running a Fortune 500 business. You don't, CEOs do not just transfer money out. Well, they don't just spend money on their personal card. They have to account for everything. So in other words, they have to make very sure that if they went to Walmart and they bought office supplies, okay, the CEO doesn't go to Walmart. send their executive assistant. But if they bought office supplies, they now have a receipt, and they have to provide that receipt to the accounting department. The accounting department then has a couple of things they have to do. They have to put it in the books as an expenditure from the right account, because a lot of businesses have more than one bank account. And if it's reimbursable, then they would reimburse the employee, whether it's the CEO or secretary or whatever. So my recommendation is think as if this is your job, not your own business. Okay, so you are actually the CFO and the CEO of your business. Pretend you have a board of directors to answer to. You have accountants to answer to. And if you do that, then it's going to make more sense. Okay, so you have to do your expense reports. And that means that if you have to spend money for the business out of your personal funds, you do an expense report. You tally up all those receipts and you transfer money to cover what you spent. That could be for anything. I was using office supplies as an example. If you're a trucking company and you have to run your personal credit card to get fuel, because, for whatever reason, you still would fill out an expense report and submit your receipts and get reimbursed. You want to do the same thing as a business owner. And the reason for that is, again, for your protection, twofold. One, now I know you submit those receipts so that the accountant knows how to account for those funds. There's nothing more irritating to me as an accountant than when I see something that's just labeled reimbursable expenses. What reimbursable expenses exactly are we referring to? Did you buy office supplies? Did you buy fuel for your car? Did you pay for advertising? What did you do with that money? I can't just put it in a reimbursable expenses account. I need to know what was reimbursed. Okay? And it could be, I took this client out to dinner to seal the deal, and I need to submit my expenses for dinner. That's fine. But again, treat your business as if you were a Fortune 500 company, as if you were an IPO, as if you had a board of directors to answer to. The board of directors can be your spouse. Okay. It can be, a couple of your close friends. It can be a business attorney, whatever. It could be me, whatever. But you do have an accountant, you should, to answer to. And that will help you immensely, because if you will do things the right way, you will find out that your tax bill will be lowered because you've done things the right way. That means we can now expense things that if you paid for them out of your personal account, we don't know about it. Okay. So you have to submit your receipt. It also creates a paper trail of, in the event of a lawsuit, that yes, I took money out of my business, and this is why. This is my salary, and it doesn't have to be payroll. It could just be, this is my draw. This is what I put in. This is what I took out, and I take out this much money every Friday, and then I spent money out of my personal account. Here are the receipts. It just makes things easier in the long run. So don't commingle your funds. If you must spend personal money on business, submit yourself, even if it's just for you, submit an expense report. If you spend business money for personal reasons, put it in your personal account first and then spend it. And that's the way it is. No, sorry, I'm not Walter. Okay. And that's how it needs to be done. And with that, I'm going to go ahead and end the video, and I'll talk to you again very soon.